In January 2019, WeWork was worth $47 billion. By November of that same year, the company that controlled it was offering to sell it for less than a tenth of that. Some estimates put its real value closer to zero. Nobody stole the money. There was no fraud trial, no hacked database, no criminal conspiracy. The company simply tried to go public, to sell shares to ordinary investors. And in the process of doing that, the entire world got to look at the actual numbers for the first time. And the moment they did, $47 billion evaporated. This is the story of WeWork, and it might be the purest example in modern business history of what happens when a story stops being checked against reality. Part 1. The pitch. WeWork's basic product was simple. Rent large amounts of office space on long leases, divide it up into stylish, flexible co-working space, and rent it back out to freelancers, startups, and small businesses on short, flexible terms. That's it. That's the actual business. Commercial real estate arbitrage with better interior design. But that is not how WeWork's founder, Adam Neumann, described it. Not even close. Neumann was an extraordinary salesman. By every account from early investors and employees, being in a room with him was genuinely electric. He didn't talk about office space. He talked about elevating the world's consciousness. He talked about WeWork as a community, a movement, a physical manifestation of a new way of working and living. He coined the term space as a service and convinced people WeWork wasn't really in real estate at all. It was a technology company, a platform, something that deserved to be valued like Silicon Valley software, not like a property leasing business. This distinction mattered enormously. Real estate companies trade at modest multiples of their revenue because the business is well understood and the risks are well known. Technology companies, especially fast-growing ones, can trade at extraordinary multiples because investors are betting on exponential future growth. If WeWork was a real estate company, it might have been worth a few $billion. If it was a technology company, reshaping how the world works, it could be worth tens of billions. Neumann needed everyone to believe the second version. In 2017, Masayoshi Son, the founder of Japanese investment giant SoftBank, visited WeWork's headquarters. According to multiple accounts, the meeting lasted 12 minutes. Son reportedly told Neumann he should be more aggressive, not less, and proceeded to write a check for several $billion. SoftBank would go on to invest more than $10 billion in WeWork, and that single relationship is where this story really starts to take flight. Because once a major investor commits billions at a sky-high valuation, that valuation becomes self-reinforcing. Other investors look at SoftBank's number and assume SoftBank must know something they don't. Part 2. The number nobody checked. Here is the part of the WeWork story that gets lost in the Adam Neumann personality coverage. The actual financial mechanics of the business were genuinely alarming and had been for years. WeWork signed long leases, often 10 or 15 years, and committed to fixed rent payments for that entire period. It then rented out desks on short, flexible month-to-month terms. This is a serious structural mismatch. If a recession hits and companies downsize, WeWork's customers can leave with 30 days' notice. WeWork's landlords cannot be told the same thing. The company was losing significant amounts of money on a per-desk basis, even in its established locations. Expansion was not creating efficiency. It was multiplying the losses. In its IPO filing, WeWork introduced the world to a financial metric that became instantly infamous: Adjusted EBITDA. Standard EBITDA already strips out interest, taxes, depreciation, and amortization to show core operating performance. WeWork's version went further. It also stripped out marketing costs, general administrative expenses, and the costs of opening new locations. Strip away enough costs and almost any business looks profitable. Financial analysts and journalists who reviewed the filing were, frankly, stunned. One widely shared critique noted that under similar logic, almost any company could claim to be profitable if you were allowed to ignore the expenses required to run it. This is the moment, more than any single Adam Neumann anecdote, where the WeWork story actually starts to unravel. Because once professional public market investors could see the real numbers with no spin and no story, the math simply didn't work at anything close to a $47 billion valuation. The IPO filing also revealed governance details that alarmed serious investors. Neumann had trademarked the word "we" personally, and then sold the rights to it to his own company for nearly $6 million. He had taken out loans against his own WeWork stock. His wife Rebecca was positioned to help choose his successor if he died or became incapacitated, under terms in the filing. The company had also leased office space from buildings Neumann personally owned a stake in. Each of these on its own might have been survivable with a clear explanation. Together, they painted a picture of a company where the boundary between founder and corporation had essentially dissolved. Part 3. The Collapse. In August 2019, WeWork filed publicly to go public, confirming the $47 billion valuation from its last private funding round. The plan was to pitch the stock to institutional investors in what's called a roadshow, then list on the stock exchange. It went badly almost immediately. Investment bank analysts who reviewed the filing independently came back with valuations nowhere near $47 billion. Some estimates circulating in the financial press put the realistic value as low as $10 billion. A few went lower still. Major investors who were expected to anchor the IPO reportedly raised serious concerns, both about the financial structure and about Neumann's conduct and control over the company. Through September 2019, the pressure became impossible to manage. The IPO was delayed again, then formally postponed. Adam Neumann stepped down as CEO on September 24th, 2019. The financial terms of his departure were, by most standards, extraordinary given what had just happened. Neumann walked away with a package reportedly worth around $1.7 billion, including stock sales, a consulting fee, and a substantial payment for stepping aside as chairman. The founder, who had presided over the destruction of tens of billions of dollars in paper value, left as a billionaire many times over. With the IPO dead and WeWork burning cash at an alarming rate, SoftBank stepped in with an emergency rescue package in October 2019, eventually taking majority control of the company. The rescue valued WeWork at roughly $8 billion, a fraction of the $47 billion peak just 9 months earlier. SoftBank went on to write down billions of dollars on its WeWork investment over the following years. WeWork itself eventually went public in 2021 through a different mechanism, a SPAC merger, at a fraction of its original ambition, and ultimately filed for bankruptcy in November 2023. Part 4. The Bluff. Most retellings of WeWork focus on Adam Neumann, his charisma, his eccentricities, the parties, the tequila shots and board meetings, the private jet. That version of the story is entertaining, but it misses the actual mechanism of how $47 billion of value can simply not exist. Here's the simplest way to understand what actually happened. A private company's valuation works a lot like a bet at a poker table. You don't need a winning hand to win the pot. You just need everyone else at the table to believe you might have one, and to be unwilling to pay the price of finding out for sure. Adam Neumann played that hand about as well as it's ever been played. He sat down at the table and bet big, not on office space, but on a story about community, consciousness, and the future of work. Early investors saw the size of his confidence and read it as a signal of real strength. When Masayoshi Son walked into WeWork's headquarters in 2017 and committed billions of dollars in a 12-minute meeting, he wasn't just making an investment. In poker terms, he was the big stack at the table, choosing to raise rather than fold. And once the biggest player at the table bets that big, everyone else starts reading the game differently. Other investors didn't independently re-examine WeWork's cards. They looked at SoftBank's stack of chips already in the pot and assumed SoftBank must know something they didn't. That's not due diligence. That's reading the bet size instead of asking to see the hand. This is exactly why private valuations can drift so far from reality, and exactly why public markets are so dangerous for a bluff. In a private funding round, nobody is forced to call. Each new investor can simply match the previous valuation and move the story forward without ever demanding to see the underlying cards face up. An IPO is different. It is structurally a showdown. The company has to file a prospectus, a legal document that puts every card on the table, visible to anyone willing to read it. Pension funds, retail investors, financial journalists, short sellers, all of them get to look at the actual hand for the first time. And once everyone could see the cards, the hand wasn't even close to what the betting had suggested. The long lease liabilities, the short-term revenue, the invented metric, Adjusted EBITDA, which wasn't a financial disclosure so much as an attempt to redraw the rules of the game right as the cards were being revealed, hoping nobody at the table would object. They objected immediately. Here's the part that's genuinely instructive, beyond just enjoying the spectacle of it falling apart. A bluff only works as long as calling it costs more than folding. Private investors who'd already bet billions had every incentive to keep believing the story, because admitting otherwise meant admitting their own chips were already lost. Public market investors don't carry that same sunk cost. They weren't already in the pot. They could look at WeWork's actual hand with completely fresh eyes, and they had every incentive to call the bluff rather than protect it, because for them, folding early and walking away cost nothing at all. That's the real lesson sitting underneath the Adam Neumann personality stories. WeWork's valuation wasn't a measurement of the business. It was the size of a bet that worked precisely because for years, nobody who mattered was willing to pay the price of asking to see the hand. The lessons. Lesson 1. Evaluation is a bet, not a fact, until someone calls it. WeWork's $47 billion number was real in the sense that someone agreed to put money behind it. It was fictional in the sense that almost nobody else in the world, once they finally saw the actual hand, agreed it was worth anywhere close to that. Lesson 2. Watch for new rules introduced right before a showdown. When a company invents a new way of measuring its own performance, like Adjusted EBITDA, right as outside scrutiny arrives, the right response is suspicion, not admiration. That's not innovation. That's trying to change what counts as a winning hand after the cards are already being dealt face up. Lesson 3. Following the size of someone else's bet is not the same as checking the cards yourself. SoftBank's billions made WeWork's story more believable to everyone who came after, but belief built on someone else's chip stack is still just belief. It compounds silently, investor by investor, right up until somebody finally insists on a showdown. Part 5. What happened after? A footnote worth adding. It's worth saying clearly, co-working itself wasn't a bad idea. The pandemic-era shift toward flexible and hybrid work has, if anything, validated the underlying demand WeWork was chasing. Competitors with more disciplined financial structures continue to operate successfully in the same space. WeWork's failure wasn't that flexible office space was a bad business. It was that the company built around it was valued as though it had already solved problems it hadn't even started solving, run by a founder whose personal interests were never clearly separated from the company's. Adam Neumann, for what it's worth, didn't disappear. He returned to real estate with a new venture called Flow, and, in one of the more remarkable footnotes in recent business history, received investment from the same venture capital firm, Andreessen Horowitz, that had previously backed WeWork. WeWork lost $47 billion in value without a single fraud charge being filed. Nobody went to prison. The numbers were technically disclosed, just buried under language designed to make a real estate company sound like a movement. That's what makes this story different from some of the others we've covered. Sometimes the most expensive business mistakes in history aren't crimes. They're just stories that everyone agreed to believe, for exactly as long as nobody checked. Next week, we're looking at a story where someone absolutely did check, and the company tried to make sure nobody believed them. Theranos is coming. Subscribe so you don't miss it.